This video is going to discuss the issuance of bonds at a discount. When the contracted interest rate of bonds, in other words, the rate of interest that the bonds are promising to pay to investors or to bondholders, when that contracted interest rate differs from what the current market rate is at the time of issue. In other words, what are current investments on the market providing in a return to investors? If the market rate is different from the contracted interest rate, the bonds will sell for either a discount or a premium. If the contracted interest rate of the bonds is above the market rate, in other words, the bonds are paying a better rate of return, a better interest rate than what most investments are on the market currently, the bond will sell at a premium. The company can charge more to investors to buy those bonds. If the contracted interest rate and the market interest rate are the same, they equal, the bonds will sell right at their par value. If the contracted rate of interest on the bonds is below the market rate, the bonds will have to be put on sale or they will have to be sold at a discount in order to attract investors, because other investment options are providing a better rate of return than what the bonds are offering to pay. So let's look at an example of issuance of bonds at a discount. We are going to prepare the entry for January 1st, 2019 to record the following bond issuance. The bonds have a $1 million par value. Their issuance price is going to be 92.6405% of their par value. The reason they have to be issued less than their par value, or they have to be sold for less than what they are promising to pay back, is because the bonds are paying a stated rate of interest of 10%. But currently, investments on the market are paying a 12% return. So in order to attract investors, the company has to discount their bonds. They sell them for less than what they will pay back. That will attract investors. The bonds will pay interest twice a year on June 30th and December 31st. The date of the bonds is January 1st of 2019. And they mature in 5 years and December 31st of 2023. The journal entry to record the issuance is going to involve a discount. The par value is $1 million. That is the amount of the liability. That is the amount that needs to be paid back. The cash that will actually be received is only $926,405. because the bonds are being issued at less than the par value. There is a discount of $73,595, which is the difference between the par value and the cash that they are sold for. This discount really represents an additional cost of borrowing the funds, because not only does the corporation have to pay interest every 6 months, but when they go to pay off the bonds, they have to pay off $1 million, but they only borrowed $926,405. So they have to pay an additional $73,595 over and above the 6-month interest payments. So we are going to not wait until the end of the bond's life to record that additional $73,595 as an interest expense. The discount will be amortized, and a little bit of that additional interest cost, or a little bit of the discount, will be spread out and recorded as an expense with each interest payment to bondholders. So whenever we make an interest payment to bondholders, we will record an interest expense for the cash paid to bondholders, plus a little bit of the discount. On January 1st, when this bond is issued, ABC would record it as follows. Cash received is $926,405, debiting cash to increase, crediting the liability for the $1 million that will have to be paid back when the bonds mature, and the discount will be $73,595. This discount is a contra liability account. It will have the opposite balance of the account it is tied to. If we were to prepare a balance sheet on January 1st, 2019, when the bonds are issued, bonds payable would be $1 million reported on the balance sheet as a liability. The contra liability account would be reported right after. The difference between the liability and its contra liability account is the carrying value of the bonds. On January 1st, when these bonds are issued, their carrying value is $926,405. Using the straight line method, we will amortize the discount. So if we have a discount of $73,595, we have 10 interest periods to amortize that discount. 5-year bonds, 2 interest periods per year, 10 interest periods. So $73,595 divided by 10 interest periods, $7,360 is the amount of the bond discount that will be amortized every time an interest payment is made to bondholders. The interest expense recorded will be the $50,000 that is actually paid to the bondholders, calculated 1 million par value times the contracted stated interest rate of 10% for half of a year, 6/12, $50,000. Plus an additional $7,360 of the discount is recorded as expense as well. Total interest expense every 6 months will be $57,360. The journal entry for the first interest payment, total interest expense recorded, $57,360. The cash actually paid to bondholders is only $50,000 based on the contracted or stated interest rate. The difference between the bond total interest expense and the cash paid is going to be the amount of the discount amortization, $7,360. Notice we are crediting the discount on bonds payable, which is decreasing the contra liability balance. Every 6 months, we're seeing here a $50,000 interest cash payment to bondholders. 5-year bonds, 2 interest payments per year, we're seeing a total of 10 interest payments. Every 6 months, the interest expense actually recorded is an additional $7,360 due to the amortization of the discount. So every 6 months, $57,360 of interest expense is recorded. Every 6 months, the discount is decreasing with the amortization. And we are seeing that here in this chart. We start with a discount of $73,595. The discount is decreasing $7,360 every 6 months. By the time we make the last interest payment, when these bonds mature, the carrying value of the bonds will be $1 million. The only thing left to pay is the liability. So we would debit the liability for $1 million and credit cash for $1 million.